There is a central paradox in modern finance. A company can be highly profitable on paper while simultaneously bleeding operational cash. This diagram shows the Henley plc anomaly. The company generated £210,000 in pure profit, yet actual cash reserves plummeted by £100,000. This happens because net profit is an accrual-based figure. It records revenues and expenses when incurred, masking the company's true liquidity. Discovering exactly where that missing £100,000 went requires a complete dismantling of the company's financial statements. The income statement tells us what a company claims to have earned. Only the statement of cash flows reveals the undeniable reality of its liquidity. IAS 7 is the international accounting standard governing the statement of cash flows. Its core objective is standardizing how we map actual corporate cash movements. Under this standard, the direct method operates as a straightforward ledger, tracking raw, gross cash receipts from customers and direct payments to suppliers. This contrasts with the indirect method, which reverse engineers accrual profit to isolate true cash generation. IAS 7 requires categorizing every balance sheet transaction into operating, investing, or financing. Current items map to operations, non-current assets to investing, and equity and debt to financing. By standardizing cash movement into these three strict categories, we create a precise diagnostic map of a firm's overarching financial strategy. This three-pane workspace establishes our analytical environment, treating the income statement and balance sheet as raw inputs. We anchor the operating activities section starting with profit before tax at £290,000. Our first adjustment comes from Note 1 for property, plant, and equipment. Accumulated depreciation grew from £200,000 to £240,000, with no assets sold. We calculate that £40,000 depreciation expense and immediately add it back to our profit baseline. The logic here is that depreciation reduces paper profit, but it consumes absolutely zero cash. Next, we locate the £30,000 interest expense and also add it back to the operating profit. Interest is added back here to isolate core operating profit, allowing us to accurately record the actual cash paid for financing later. The first step of the indirect method is purely surgical, stripping away non-cash adjustments and financing distortions to reveal the raw operational baseline. This visualization shifts our analytical focus to the current assets and current liability sections on the comparative balance sheets. Working capital measures a company's short-term financial health, and the mechanical rule for it is strict. Increasing assets consume cash, while decreasing liabilities consume cash. Analyzing the inventory delta, we see a drop from £410,000 to £350,000. Selling off £60,000 of goods without replacing them frees up operational cash. Trade receivables, however, show a massive jump from £140,000 to £260,000. This £120,000 must be deducted. That capital is currently paralyzed in unpaid client invoices. Finally, trade payables drop from £320,000 to £170,000. Paying down £150,000 owed to suppliers actively drains cash from the business. These working capital deltas expose the exact efficiency of a firm's short-term liability management. Soaring sales mean nothing if clients do not pay. Warning tone. Avoid the common novice error of pulling tax and interest expenses directly from the income statement onto the cash flow statement. This equation shows the rigorous mathematical formula required to find actual cash paid. Opening liability plus income statement expense minus closing liability. We execute this formula for interest payable. £0 open it plus £30,000 in expense minus a £10,000 closing balance. We record the resulting £20,000 as the actual cash outflow for interest. We execute the same formula for current tax payable, £50,000 opening plus an £80,000 expense minus £70,000 closing. We record the £60,000 result as the actual cash outflow for taxes. This is distinct from the £80,000 expense reported. Tallying all of these operational adjustments reveals a net cash from operating activities of £70,000. Reported expenses reflect accounting timing rather than physical cash movement. Precise reconciliation of liability accounts is the only way to uncover the actual operational drain. We now direct our attention to the bottom half of the balance sheet, non-current assets, non-current liabilities, and equity. This view zooms in on the property, plant, and equipment cost line to investigate investing activities. The cost grew from £600,000 to £1.1 million, with no assets sold off. We record this £500,000 delta as a capital expenditure cash outflow under investing. We shift to financing activities by analyzing long-term borrowings. The jump from £0 to £370,000 is recorded as a major cash inflow from newly issued corporate debt. Finally, we scan the equity section and statement of changes in equity to identify shareholder payouts. We log the £90,000 dividend payout, adjusting for the remaining payable balance as a financing cash outflow. Aggressive capital investments and generous dividend policies easily exhaust operational cash, forcing a company to leverage itself with new debt simply to remain liquid. This diagram brings the three completed cash flow sections together. We sum the subtotals: £70,000 from operations, minus £500,000 for investing, plus £330,000 from financing, revealing a net cash decrease of negative £100,000. We verify this against the opening and closing cash balances. The reconciliation is mathematically perfect, validating the movement between the two balance sheet dates. Henley plc is not failing. It systematically used its own cash and took on debt to fund a £500,000 infrastructure expansion. This mechanical reverse engineering process is universally applicable to any set of accrual financial statements. We now turn to the upcoming Thames plc data from Exercise 3. Thames plc introduces new complexities, including current portions of long-term debt and new share issues. Deploy the exact indirect method framework just demonstrated to map Thames plc's financial engine. Mastering IAS 7 allows an analyst to bypass reported profit and strictly verify the specific mechanics of corporate liquidity.